This video is one of the most important videos you'll watch about liquidity. Hello everyone, this is Mohan from Mohan Trading. Today's video I'm going to go over some advanced liquidity concepts, high resistance liquidity run and low resistance liquidity run. I'm going to go over them and how can we apply them into our trading setups, and I'm going to go over some examples. If you guys like my content, make sure you subscribe to the channel, like the video, and join my free Discord. Let's dive in. Before getting to the video, I would like to announce that I have partnered with Bespoke Firm, which I found it offers one of the best tools nowadays to give away 325,000 accounts to 3 of my subscribers. To get in the giveaway, you need to do the following. 1. Subscribe to my channel. 2. Follow me on Twitter. 3. Follow Bespoke official account on Twitter. And finally 4. Leave a comment under this video with your Twitter account. And I'll announce the winners next Monday, May 1st. So first of all, we need to cover those things. We all know that liquidity rests above swing highs and rests below swing lows. So swing low, we have liquidity here. Swing high, we have liquidity here. This is the most basic definition of liquidity. Now, let's say we were going down, making lower highs, okay? This way. So now, what do we have? We have people shorting here, stop loss just above, and then going down. Let's say this trade. And then price make another high, price goes down. We have people shorting anywhere in here, let's say here, and then we have stop loss just above, and then targeting anywhere. Similarly here, let's say here, we have people shorting from here for any reason, having stop loss just above. Now we have liquidity here, and then liquidity here, and here. So we have liquidity building above every swing high. We have this, and this looks like a trend line, right? So let's all agree that this is a trend line. This way or this way, say this. So this is a trend line. Now, on the other hand, let's say price was coming down, and then price made a high, and then goes down, and took that high, go down, break a structure here, and then make another high, and then take that high and go lower. Now, in this case, the second case, what do we have? We have sweep right here, and we have sweep right here. We have breakout structure here, and a breakout structure here. What does that mean? That means that there was a liquidity here. So there was a liquidity here, but then smart money swept that liquidity, and then now we have much less liquidity here. There's barely any liquidity. There's still liquidity for people who short here, put their stop losses here, but it's not as much as the stop losses above those swing highs. So now price goes down. What do we have? We have another sweep. So there was a liquidity right here, but then what happened? Smart money swept that liquidity, goes down. So there's barely any liquidity in here. And what else? We have, let's say, a lot of PD arrays here. We have a mitigation block, we have a breakup block, we have an order block, we have a fair value gap. Let's just go with a fair value gap. So we have a fair value gap here. We also have another fair value gap here, let's say. Now, this on the left side is a low resistance liquidity. On the right side, this is a high resistance liquidity. What does that mean? That means that this liquidity is so easy to be taken because there is a lot of retailer liquidity right here. On the other hand, right here, there is no much liquidity. All of those sweeps are smart money moves. Price goes down with the order flow. You see how those sweeps are with the order flow. Now, how can this affect your trading? So let's say there was, for any reason, there's a setup here. and you want to enter and go long, say here, and you're targeting anywhere in here. Similarly, you're also entering here. What is the difference? The difference is on this trade, you are trading with the flow, with the order flow. On this trade, you are trading against the flow. You can see the flow was down. Here, on the bigger picture, it's going to be with the order flow. In this case, price will come down, take your order, and then fly with the displacement. It's going to go up, take all of this liquidity. It's going to be much cleaner. It's going to take less time, and it's going to be flying with the displacement. As we all know that those trend lines are always ended with a breakout. This is going to help you instead of watching the chart and then prices consolidating and taking a lot of time. You may take some wrong decisions. It's going to affect your psychology. It's going to make you scared. This is not going to happen when you're trading in low resistance liquidity conditions. On the other hand, if we take a look at this, we can see that this is a high resistance liquidity. It's so hard to take. You are trading against the order flow or the bias. It takes more time. Let's say it's going to go to the take profit. It's going to take more time. It's going to affect your psychology. And you may close the trade earlier. It may hit your stop loss. But it's going to make you scared in some way. It's so hard to trade in high resistance liquidity condition. It would not be in sync with other correlated pairs. So my advice is only execute in low resistance liquidity. So my advice is only execute on low resistance liquidity conditions. It's going to give you an edge in trading. In this example to the left, the trend line, price will easily break all of those points. This trend line is going to take them very easily. This is a smart money move. Take all of this liquidity. On the other hand, right here, you're trading against the smart money. You can see you have a sweep, you have a fair value gap, you have a sweep, you have a fair value gap. Do you think that your $50 or $100 or $1,000 position and let's say 2 pips stop loss is going to take all of those fair value gaps easily? That's not going to work. Let's say even if you had, let's say right here, you had equal highs, even equal highs, and the price goes down and then give you a high resistance liquidity condition, those equal highs are not guaranteed to be taken. I know a lot of people who find setups, then let's say they will enter here and they're always targeting the equal highs. They fail. And then they enter another time. When they find any setup, they enter and then they're always targeting what? So let's say they will enter again here and then another tight stop loss and then targeting where? The same equal highs, thinking that price will easily go above those fair value gaps, those order blocks, those swing highs. There's a lot to be taken before reaching those equal highs. So not every equal highs will be taken. That's not how it works. So if I want to relate to a real life example, let's say the one to the left is when you play football and you are against a player or two. You can't go past them. On the other hand, when it comes to the high resistance liquidity condition, it's different. It's like you are a player against 5 players. It's much harder to pass all of them. Now it comes the main question. How do we apply all of those concepts into the chart? So basically, we want to focus on the low resistance liquidity condition. So let's say this trend line here, we only trade with this condition. We stay away from the high resistance liquidity as it's going to be so choppy. It's going to take a lot of time. So basically, we want price to come here, give us a trade, and we're going to target this liquidity right here. It's going to be a higher probability setup. So you want to trade a POI or a sweep or your main setup here. So whatever your setup, you want to see it happening here, and then you enter here, and then you target the liquidity, and then your stop loss just below the PD array or the sweep or whatever. So it's all depending on your setup, but then you want to see this happening just before your setup is presented to you, and then you can enter targeting this liquidity right here, and then stop loss just below. You won't know how effective this is until you start backtesting. So now let's go over some examples. Those examples are just to explain how price will react when there is a low resistance liquidity. That's all. Maybe in another video, we will apply one of the strategies that we explained in the channel with the use of low resistance liquidity. In this video, I just want to show you when we identify this low resistance liquidity, how price will react from there. So let's take a look at this. We can see that price was moving up smoothly. Price make a low here, this low, and then make another low here, and another low here. You see, there's none of those lows were broken by the other one. So those are clean lows. So now we have this kind of low resistance liquidity. What we can do is go and look for 15 minutes, for example, and look for a point of interest. What do we have? We have this big fair value gap. And then if I go to the 5 minutes, you can see that there is an inducement here. The fair value gap and can be minimized this way. We have a small one here. Price come here, doesn't mitigate the fair value gap and goes down. So now we have liquidity. So what we can do is just set a limit order at the beginning of the fair value gap, middle, whatever your model is or setup, just do it here. But just for the sake of the video, I want to make it as simple as possible. I'll just use the fair value gap every time, just to show how price reacts in a point of interest when there is a low resistance liquidity. So basically, right here, stop loss, say, just above the fair value gap, maybe this one right here, and then targeting this low right here. Can't target this low, but then this one is 3.7, so that's enough. So basically, if we forward, you can see the price tagged into the point of interest, and then you see how clean price is. It goes straight into the targets. That's what we want to see. Price action that's not noisy, that's not gonna affect our psychology. That's all we want. You see how price immediately goes to the target. The only bad movement that happened is this candle. All of the other candles are so clean and nice. This is another example just to show how price reacts. We have right here, here, then here, and still not taken here. But then for a trend line, I'll consider like all of those this way. So let me make it more clear. So you see how those are all clean highs? I want to bring a trend line here. This is like a trend line. See? So basically, what's gonna happen next is price going up. So price sweeps the high here. After sweeping the high, you may enter on your setup or wait for your setup anywhere. But then the thing that I want to show you is how price reacts. There's a setup and then there is the liquidity, the low resistance liquidity. That's how it does. See how price? It immediately goes and take all of the liquidity. That's the easy to take liquidity. We don't want to deal with high resistance liquidity. This is the way. And this is the last example that I'm going to cover. So we do have those highs, high and a high. This one is inside this one, and there's a potential, this one. So basically, this is my trend line here. It's not the perfect trend line, and remember, it's not gonna be always as easy and as simple as I show you here, and it's not gonna be as clean as this. It's always gonna be harder. So basically, we have this trend line, not the best trend line, but this is a nice low resistance liquidity. Now, if we go to the 15 minutes, for example, what do we see? Do we see something? Sweep here, So maybe after the sweep, you may go and look for your setup or whatever setup you use. I know a lot of people who go aggressively after the sweep, but I'm just showing you how price reacts, and that's how it does. The price immediately go up and take all of this liquidity just after the sweep. So the sweep happens here, price goes aggressively, and a small retracement here for a single mitigation candle, then goes up